So, welcome to our webinar called Walk Through Financial Statements Understanding Your Farm Income Statements. Our presenter today is Andy Larson of the Food Finance Institute, which is based out of the University of Wisconsin-Madison. I am Larissa McKenna, FACTS Humane Farming Program Director, and I will be moderating the session. I thank you all for joining us today. So, just a minute or two to do some quick introductions before we dive in. Food Animal Concerns Trust or FACT. We are a national nonprofit organization headquartered in Illinois. We work to ensure that all food producing animals are raised in a humane and healthy manner. And to accomplish this, we work with by supporting humane farmers, promoting policies that make food from animals safe and healthy to eat, and then also helping consumers make informed food choices. So I direct FACT's Humane Farming Program, which works with livestock and poultry farmers across the country. We offer a range of services, including grants, scholarships, personalized materials, mentorship, and of course, webinars on a variety of fascinating topics. We also, this might be of interest to a lot of folks on this session, just launched a new financial training program for farmers. And we are accepting applications through the end of October. So please visit our website to learn all about our farmer services. At this time, I am delighted to introduce our guest presenter, Andy Larson. Andy is the Farm Outreach Specialist at the Food Finance Institute, at the University of Wisconsin-Madison. Andy has experience in strategic farm business and marketing planning, farm financial statements and projections, agricultural credit and loan structure, loan guarantees, credit enhancements, farm succession, and intergenerational transition, among many things. There's a long
He's a
list.
big nerd.
He's also a self-proclaimed nerd and raises a flock of pastured laying hens in his spare time. It's a pleasure to have you with us today, Andy,
Thank you.
to share your experience and expertise. So I think at this point, I'm just going to hand it over to you so you may begin. So
All right.
take it away. I'm going to
I'm
take
pulling up
my.
my screen here, and Larissa, you let me know if for any reason that isn't working appropriately. Y'all, I'm doing kind of that dual screen PowerPoint thing, so just holler at me if things aren't advancing the way that they are supposed to. All right, so Larissa gave an intro of me, and I wanted to show you here that I am among you, right? I do have my wife and I started a small scale poultry farm in 2014. We produce free range brown eggs for local markets. We have about 600 hens at the height of the growing season, so we're extremely small, at least by industry standards. We sell primarily to restaurants and retail stores, but I grew up on a small scale dairy farm, which was near the Illinois Wisconsin state line. Did my darndest not to learn anything while I was growing up, of course, and didn't realize what I was missing until I went to college and decided I'd try to figure out how ag and natural resources and business could kind of coexist and sustain one another. Wound up with an MBA and a minor in sustainable ag from Iowa State, worked as an extension educator there in Iowa and over in Illinois, mostly farms, local food. Then spent a few years as an ag banker at a small community ag bank, making loans to conventional farmers, but also some very unconventional farmers. So with that experience and this farm that I have up in front of me, I'm probably dealing with a lot of the same questions and issues that you guys are about how to be a good farm business manager, how to grow, how to access capital, how to, continue to improve this thing, onward and upward forever and ever. Amen. Yada yada. So, what they tell you in extension school, right, is to say what you're going to say it, and then say you said it. So, just to summarize a couple of the high points that we're going to discuss today. Okay, the income statement is one of the big three, right? The big three financial statements, along with the balance sheet and the cash flow statement. All of these things are connected to one another, and we'll talk about how as we go along a little bit today, but also in future webinars that Larissa will mention at the end. We got another one coming up next week. I bet a lot of you are signed up for already. The income statement is frequently called the profit and loss statement. So I mentioned this for clarity, but also I need to acknowledge that one of the biggest barriers for normal humans to understand the financial world is the jargon. It's not really that finance people like use big or hard to spell words, but they use very simple words that mean a very specific thing to them, but not always to others. I've got a number of friends who are like engineers and physicists, and when they talk about fluids and materials, I know they're talking about something different than what I think they mean. So, as such, I'm going to do my best to point out exactly what I mean when I say some of these important words. I'll also try to mark them in italics on the slides. I hope I remembered all of them. If I don't say what I'm talking about and it's confusing at all, please harass me mercilessly and I will fix the problem. Okay, the income statement, what does it do? It summarizes revenues and expenses associated with your business operations, plus just a few other things called non-cash accrual adjustments. More to come on that in the very near future. It indicates profitability over a certain time period that your farm has been operating. Usually this is a calendar year, but it could be something different too. It could be a quarter or a month, depending on how often you do this. The other thing that I want to point out right from the get-go is that a income statement is not the same thing as your Schedule F. Even though some farmers and some bankers even use it this way, um, they have a different purpose from a practical standpoint. A Schedule F is really it's to report out your farm activities to the government and to quote unquote air quotes here you can't see optimize your tax burden. While an income statement is really to help you paint the most accurate possible picture of your farm profitability. Schedule Fs do paint a picture. Whether or not it's the most accurate for your own decision making is up for argumentation. Last but not least, the income statement is different for farms versus non-farm businesses. We'll touch on this just at the very end. I'll probably refer to those non-farm businesses as Schedule C businesses because instead of a Schedule F, profit and loss from farming, they file a Schedule C with their annual tax return, profit and loss from business. We'll talk about why they're different, and it mainly has to do with a little acronym called COGS, cost of goods sold. More on that than you could ever hope for in the very near future. I did want to point out, go ahead and remember to throw questions into the chat pod. I can't currently see it, but Larissa will yell at me if anything pertinent pops up, and we will try to address those as we go along, if they can't wait, or if they provide some clarity to what I'm talking about right there and then. Okay, the big three financial statements, they are used really in combination with one another to evaluate the financial health and the financial position of a business. I'm going to present them in alphabetical order because balance sheet is an inventory of your assets and liabilities, what you own and what you owe. You might hear it called the net worth statement, but that's usually when you're talking about personal finances. But the difference between your assets and your liabilities is your net worth, right? So net worth statement. So a balance sheet is going to indicate liquidity and solvency. So both of those in italics, words that mean something, right? Liquidity is a measure of your ability to pay your obligations in the near term, the bills that are coming up generally within the next year. How much cash or cash equivalents do you have on hand to take care of those things? Solvency is more of a large scale measure that's basically if your farm business got sold tomorrow, could it pay off all its debts? That's the thumbnail for solvency. The second one is the cash flow statement. So this honker provides I'm trying to think of just like the most colloquial way to say this. It's a change in cash position. It really is the best approximation of your checking account at the end of the year. And that change is due to operating activities, investing activities, and finance activities. Okay, 3 words that seem common but mean something very specific, right? We mentioned that. I warned you about that. So operating activities, those related to a business's line of business, right? What they buy and sell to generate revenues. Investing activities, when you're talking about a farm, are generally the things your business does when it buys and sells capitalized assets like machinery and real estate. For farms, this is primarily farm equipment, over the road vehicles, farmland, that kind of thing. Finance activities are the ones that have to do with loans and lending. So when you're getting a new loan, back principal on a loan, that is a finance activity. This also happens to be where we put things like personal income injections, because really that is kind of like you personally are making a loan to your business. So the cash flow statement, what it's designed to do is indicate repayment capacity. That's a very substantial interest to your banker. Wants to make sure that your farm business has the ability to make its debt payments on time after all the other expenses and investments are accounted for. The star of today's show, here is the income statement. First and foremost, a summary of revenues and expenses created as a result of a business doing its business. It generates the information necessary also to populate the operating activities section of the cash flow statement. So that's how it fits in with that one above. A complete income statement will also include a couple of things called accrual adjustments, non-cash items, in order to accurately reflect the bottom line profitability of a business and its operations. More on that coming up here soon. Okay, I don't mean to beat a dead horse here, y'all, but I've got to belabor the terminology thing just a little bit more. Revenues, these are income from sales of goods, income from sales of services related to your primary operations. So what I'm trying to point out here is that not all cash inflows are revenues. Okay, selling a tractor is a cash inflow from investing. Receiving loan proceeds, it's a cash inflow from financing. Those are not necessarily revenues. Expenses are the costs related to operations that generate your business revenues. Not all cash outflows are expenses, all right? Just like on the income side, on the expense side, purchasing a tractor, it's an investing activity. Making loan principal payments, it's a financing activity. Interest payments on loans are actually considered operating expenses, basically because interest is the rent you're paying on somebody else's money, generally the banks. Profitability is the difference between the value of the goods you produce and the cost of all the resources that you used in order to produce them. However, for an accurate and I guess more complete portrayal of profitability, we have to make some accrual adjustments to account for the non-cash changes in farm income. I keep saying that. These non-cash changes, what are these? Well, let me give you an example here. An accrual adjustment is generally indicative of a change in inventory. And a change in inventory can affect revenues and expenses over a period. Imagine a grain farmer, okay? I have a lot of corn farmers here in my neck of the woods. So imagine a grain farmer has got $100,000 of corn in storage at the beginning of the year. All right. Put a lot of it from last year's harvest into storage and held on to it. And this year, at the end of this year, they have $0 in corn storage at the end of the year. They sold everything they had in storage plus everything they produced this year. So there may be pretty substantial income from the sale of grain on the income statement that year, but that revenue also needs to be offset by an accrual adjustment representing the grain inventory, the grain on hand, because that is going to have a negative $100,000 reflection on the overall financial position of that farm. Without that, you could be painting an inaccurate picture of the true financial position. I'll harp on that example again in case it didn't make complete sense the first time. All right, so this accrual adjustments thing that I keep mentioning, where does it come from? Why do we need it? Well, it's kind of helpful to understand the basic differences between cash basis accounting and accrual basis accounting. And I promise we are going to get past the definitions here before too long, I swear. In accrual accounting, revenues and expenses are recognized at the time they occur. This seems like a duh statement, right? So larger farms, publicly traded companies, and I meant to say firms, larger firms, some larger farms might go this route, but not typically. They're going to use accrual basis accounting. What it does is it smooths out the lumpiness of the revenues and expenses over the course of the year when you have to, report that stuff publicly. Plus, they have like teams of professionals that do all the record keeping analysis. So just to keep this at the sort of barnyard scale, let's imagine our grain farmer again. Separate example, okay? So they've got their grain custom combined, all right? And then they sell that corn after it's combined at the grain elevator immediately. If that farm's accounting was being done on an accrual basis, the farmer would book the expense of the custom combining just as soon as it took place, right? And book the revenue of that corn sale as soon as it was delivered to the elevator. So even though nobody's got a check, no payments have been made in real life, they're going to book that revenue and that expense right away. So just hold that in your mind for a moment. Now, in cash basis accounting, revenues and expenses are recognized when the actual payment changes hands. So this is much more typical for farms and small businesses because basically it's simpler. They don't have a need or a desire, frankly, to have accountants releasing public financial statements on a quarterly basis or whatever. So instead, under cash basis accounting, that same farmer who hired their corn custom combined and then sold it at the elevator would do what most of us would do, which is that they don't book the expense of that custom combining until they send the check. They wouldn't book the income from the grain sale until they had deposited the proceeds from the grain sale in their own checking account, right? That's what we tend to do in practice. Most small businesses are going to tend to do that in practice. And if you need to confirm that your farm is on cash basis accounting, you can pull out your most recent Schedule F, your profit and loss from farming, and there's a little checkbox at the top. Let's see if I remembered that. Nope, not yet. It'll be coming up in a second here. There's a little checkbox at the top that says whether or not you're on a cash or accrual basis. And let me tell you, I've seen a lot of family farm tax returns. I don't ever remember seeing the accrual box checked. So just FYI. So one thing that this does create the opportunity for is some inventive tax planning around the end of the year. Farmers, like most any entrepreneur I've ever dealt with, have a pretty well developed allergy to income taxes. So they do some things which are all completely legal, mind you, to air quotes again, to optimize their tax burden, especially when they they like to say when they made too much money that year. All right. So, for example, you can see some farmers deliver grain to the elevator in late December, but wait on depositing that grain check until January. All right, have a lower total income from the current year. Buy seed corn in November. They've got discounts in November, but you're not going to plant that stuff until April, so you're taking an expense and moving it forward into the current year when you're actually using that inventory in the next year. And we probably all know somebody who's bought a pickup truck in December and then accelerated the depreciation just to make sure that they had a little bit more expense in the current year. I mean, these are very typical things that happen with farms and small business. Of course, you still got to pay the piper, right, the following year, but it's a whole year away. Who knows what the next growing season will bring? I mean, there's a lot of variability in farms from year to year. So they cross that problem when they come to it.
Andy,
Yeah,
we have a question that might asking for clarification in the chat
sure.
bar. When using cash basis, the question is if a check changes hands, is it when the check is received or when the check is deposited into an account or when the check actually clears into the account?
Oh boy. So these are people that are really getting into some details here. So you can do it however you want. Those people who still balance their checkbooks on paper, they tend to book that expense when they write the check as opposed to when it arrives and when it clears. Of course, as the banker, my thought was that okay, that can be in the mail for a couple of days, and maybe it won't get deposited for a couple of days, and maybe there'll be some more deposits in the account in the in between time to cover that check. Not that I had any people I knew that were like that, right? Um, the answer is it's flexible, and I would just be consistent in your operation. Um, I would prefer if it were me and I were sending a check for payment of a service, I would like to book that expense when I send the check, as opposed to having the variability of the vagaries of the mail system and also the vagaries of when that customer receives it and decides to deposit the thing. Um, that way, I maintain control. Um, yeah, but if you're the type of person who wants until the absolute last possible second to recognize that expense, you have that option as well. If you mail something on December 30th and it doesn't arrive to them and get deposited until January 2nd, I suppose you have the option to do either one, depending on how you want your taxes to look that year. A horrible non-answer, but yeah, you can choose what you want to do. I don't know of one that's more legal or appropriate than the other. Okay. Thank you for that clarifying question. And I want to point out that most of us are never going to get to a true accrual basis farm income statement. We make accrual adjustments that'll get us to a truer picture of the farm's incomes and expenses, but what we're trying to do is really paint a picture for ourselves and for our bankers, the overall financial position at the end of the year. So I'm going to put up a couple of categories of adjustments on the screen. You don't have to write them all down right now or anything like that. We'll deal with them in a minute. These, I want to talk about where these come from. So these accrual adjustment things, where the hell are they from? They come from the balance sheet. And we haven't talked about the balance sheet very much yet. We'll talk about it next week. So if the terminology appears unfamiliar, never fear. We'll get you there. We'll get you there next week. But suffice it to say, if you're not already in the habit of producing a balance sheet for your farm every single December 31st without fail, I want you to get in that habit. Why? It's because the change in these balances from one year to the next year is going to produce the adjustments you need to paint an accurate reflection of your income and expenses on your income statement. So please, 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 and I'm channeling the spirit of all of your bankers here around the country. Please produce a December 31 balance sheet for your farm. Why do we even have to do this? Without these adjustments, you and your banker may be getting a pretty skewed picture of your farm income for the year in question. So let's think about our grain farmer again for a moment. Say cash expenses this year were $10,000 higher than the cash income. Ooh, not good. Farm cash income appears to be negative $10,000, rough. But imagine that farmer had no grain in storage at the beginning of the year because they sold it all right after the previous harvest or whatever. But this year they held on to it because they're waiting for better prices or whatever. And so now they've got $100,000 worth of corn in storage. So that accrual adjustment for the corn inventory is going to make their year look a heck of a lot better than it did just from the cash farm revenues and expenses. So when you have large fluctuations in inventory, which many farms have a tendency to have, it's really, really worthwhile to be thinking about doing a complete income statement with these accrual adjustments on it. Oh, there's our good old Schedule F. Okay, I'm going to warn you. I'm going to put some documents up here on the screen. And they're documents that people use. And I apologize that they're busy, but I haven't come up with a better way to teach people about income statements than to show what they're supposed to look like. So just before you start hyperventilating, just be aware that that's coming. So let's take and move this from a concept talk to a real putting in practice talk. So you dug out your Schedule F. You want to make sure that you're on a cash accounting method. Fine. As long as you got it out, keep it out. Let's use it. Let's create a full-fledged farm income statement from it. If you're a new farmer and you've never filed a Schedule F, that's fine. You can just use your records from this year's revenues and expenses. But if you're an experienced farmer, if you got a couple years under your belt, just pull that thing out and let's follow along for a minute here. The template that I'm about to show, okay, here it comes. It's busy, I know, but we're going to take it piece by piece. Don't worry. So this is part of a larger order spreadsheet from Iowa State University Extension's Ag Decision Maker. It's called C3-56 Farm Financial Statements. Catchy name, hey? It's a powerful accounting tool for creating what I would call a pretty comprehensive set of statements, and also evaluating the financial performance of your farm against industry benchmarks. What the rest of the industry is doing that year or that last year. This income statement is one of the tabs of about like 7 tabs on that thing. And that link to get to the thing, if you want to go to it right now, it's right over there on the left-hand side of the slide. It should be a live link. You can go to it, or you can Google C3-56 and Ag Decision Maker. It should pop right up. So in order to use this in isolation and not connected with the other tabs, okay, this is for the Excel nerds out there that are downloading this thing right now. You're going to have to go into Excel, you're going to have to go into your review menu, and you're going to have to press unprotect sheet. Then you'll be able to do what I'm doing on this spreadsheet in these examples. But of course, you do that at your own risk. When you unprotect something, you have run the risk of running errors into it. Okay. If you're viewing this on a phone or tablet and this thing looks garbled and you can't read it, don't worry. Come back to it on the archive version on a larger screen. I'm also going to go piece by piece, so you're going to see all this stuff in a larger format. So, all right, y'all, cowboy up or cowgirl up. Let's make one of these things. So first, we're going to focus on the left side of the income statement, where we plug in these things, our cash revenues and our cash expenses, to calculate our net cash farm income. So this template here, it includes a number in parentheses after each category. You see that 1A and that 2 and that 3A and that 4A there in the upper right-hand corner. These corroborate with entry lines in the Schedule F. So yes, I told you that the Schedule F is not an income statement. I know, I remember, but you can use the ingredients to create an income statement. So let's start with these cash revenues, the top left part of the template. Plug and chug, throw all those numbers in and by the way, these are real numbers. This is from a farm, mine actually, from 2020 Schedule F tax return. So these are a real-time example of how to do one of these things. One thing that I do want to bring up here, I know that the folks that are listening to this are not all your conventional, like, cows, sows, and plows, quote unquote, farmers. Probably a lot of you are doing something unconventional, something niche, something value added. I get that. But one of the things that I've always encountered is that ag economists and extension personnel who develop tools like this, they've got to design them to fit the majority of their audience. So the majority of the farmers in their state or their region. So many of the best financial tools that you download from, a university extension or wherever, look like they were built to fit the mold of a conventional crop or livestock operation. Not necessarily a farm that looks like ours. I get it. What you need to do well, okay, just case in point. Line 1A, right? Sale of livestock and other resale items on the Schedule F. The little template that I pulled up here just says sales of livestock bought for resale. It doesn't have anything about other resale items. My farm we buy in some eggs from other local farmers, similar free range poultry farms, in order to meet all the demand we've got. So we actually do have some other resale items that are not livestock. And the sales of these things would be listed on 1A of the Schedule F. So why don't they get to go in this template? Well, they do. And I'm just cramming them all into that 1A line that says sales of livestock bought for resale. It's a discrepancy. I get it. And we're also going to have to pay close attention on the expense side to see where the number from line 1B ought to go. So let's remember that. Keep that in mind for just a moment. I guess all of this is basically to say, I don't think there's any way to make all of these tools one size fits all. So we've got to remember that our farms don't always look like the majority of the operations that, you know, outreach educators like ag economists and extension professionals are attempting to serve. So the most powerful thing that we can do, I think, is just have some perseverance. Think critically when we're using these tools and adapt them as best as we can to our unique operations. So I wish I could throw something on here that was just perfect for each and every one of you and had all the categories that every one of you sell in. But we're going to talk about making this income statement better in the future for your operation. So just give me a couple slides, and I promise we'll get to the punchline there. Okay, part two, right? Part two of the Schedule F, that's the farm expenses side. Once again, plug and chug, throw all those things into the expense portion of that income statement template. Couple things to point out here. There's no space for line 14, depreciation. Why not? Well, depreciation isn't a cash expense. I mean, not really. Did you ever write a check for depreciation? And if so, who'd you write it to? There's also no space for line 21, A and B, the interest sections. Paying interest isn't really a result of your farm's primary line of business, right? You're not in the business of generating interest. So it's the rent that you're paying on somebody else's money. I mentioned that before. Both of these things will re-enter the picture. I promise. They're just going to re-enter the picture on the accrual adjustment side of this income statement template that we're using. Okay, as I mentioned in the last slide, line 1B from the top of the Schedule F, it's technically an expense line, right? The cost of that resale livestock or other resale inventories, but it doesn't have a cell up there. Okay, so in order to get a realistic picture here, what I'm going to do is slot it down in the livestock purchase category because, you know, if that 1A line was just livestock bought for resale, then they're talking about 1B going into the livestock purchase section here. So that's where I'm going to slot it in to give myself a realistic picture. This will get me to an accurate bottom line number. Of course, it's useful. Make yourself a note, reminding yourself how you got there. How did you operationalize the adaptation that you came up with when you were persevering to use these tools, right? Another approach would have just been to place the number from 1C into the cell for 1A, and that'd be fine too, but then it eliminates the record of my cost of inventory. Ooh, cost of inventory. We mentioned these. What might otherwise be called cost of goods sold or COGS. This is a premonition for the end of the slideshow here. The second time we've mentioned COGS, and the second time you realize we don't really use that very much in agriculture. We'll talk about why this is significant just a little later. All right.
Well,
So
we have a question.
Larissa, go ahead, please.
Yes, we have a question that just came in before we move on. It says, is the use of your personal vehicle accounted for in the car truck expense, or does it reflect dedicated farm vehicles?
Great question. So my farm truck is a 2010 Chrysler minivan. It also happens to be what my wife drives on a daily basis to haul the children around, furniture to the recycle bin. I mean, all of that stuff. So, yes, you can absolutely account for the use of your personal vehicle for farm purposes. As a matter of fact, there's a bunch of apps out there that'll automatically track trips. I mean, they'll eat the heck out of your battery, but they'll automatically track your trips. And then when you get home, you can kind of say, yeah, this mileage was farm related or it wasn't, or business related or it wasn't. And yeah, every year the IRS publishes a per mile reimbursement rate essentially for the cost of using your personal car for business purposes. This year, I believe it's 56 cents a mile. You can get fancier than that. You can start tracking all the actual costs of repairs, of tires, of fuel, and all of that. It gets a lot easier to do those things when you have a dedicated vehicle. So, since I do not have a dedicated vehicle for the farm and we are using my wife's minivan, that's why we get that car and truck expenses as a big center of cost for our operation. We drive a lot of miles in that doggone thing. Each one of our egg deliveries, whether it's one stop or five stops, generally has to go, 30 to 45 minutes away from where we live. So we rack up quite a significant number of miles. And at 56 cents a mile, I think it was 54 and a half maybe when this got calculated, or maybe it was 58. I can't remember. It changes every stinking year. That's where that big car and truck expense comes from. If you had a separate vehicle and you had your own gas tank and you were buying gas in bulk and you could put it on that gas, fuel, and oil line, that's fine. You can do things like that. And every expense that you have for repairing that dedicated vehicle, that can become a farm expense. But um, when you're using your car or truck that you drive personally, I recommend that that expenses to be recorded in line 10 there on the bottom of the Schedule F. Great question. By the way, I forgot to mention, we did get ourselves to a net farm income here, a net cash farm income. This is before any of our accrual adjustments, right? We have a net cash farm income of $23,912. That is the total cash sales, income, revenues, whatever you want to call them, minus the total cash expenses. It's a positive number. That's a good thing. So, accrual adjustments. We're going to see whether or not that positive number is telling a true story or not here. So let's look at our cash income again. This is the same numbers we put in on the top left part of that template. And then there are some income adjustments on the top right part of that template. Hedging accounts, I know the question is going to be asked. Hedging accounts are basically deposit accounts where if you're marketing grain on the board, if you're marketing animals on the board, the Chicago Board of Trade, sometimes you have a hedging cost. Most of the folks in here are probably not going to be dealing with that, and I'm essentially going to ignore the hedging side of things, of grain marketing, for the purposes of this presentation. That being said, many of you could have some of these other inventories that change over the course of the year. What kind of crops do you have in storage, whether they be for sale or for feed? Market livestock, breeding livestock, those that are, for the purpose of creating new market livestock. Accounts receivable. Okay, on my farm, we book accounts receivable when we bring eggs to a restaurant. We provide them with an invoice and they say, thank you, we'll send you a check in the mail. So we don't have $105 in cash, we have $105 in accounts receivable, right? That check usually comes pretty shortly thereafter. So it is a cash equivalent, and for all intents and purposes, really can be kind of considered income at that point in time. And that's why it's considered an accrual adjustment to income. So at the end of last year, I had $105 in accounts receivable. At the end of this year, I've got 210. So instead of one restaurant needing to pay their bill, we had two restaurants that need to pay their bill or whatever. So we had a positive net adjustment to income based on a current asset called an accounts receivable. Our breeding livestock, that was the same. We had the same inventory of hens at the end of one year as we did the next year. Um, all that gets subtotal and creates a net adjustment to income, just like I mentioned. So our cash income, $79,215, generated by the stuff there on the left. $79,320 when you add $105 for that increase in accounts receivable. So that is your gross farm income, gross farm revenue, A plus B. Trying to see if there's anything else that I wanted to point out that I forgot here, because I'm getting ahead of myself and not using all my notes all the time, so apologize for that. um, oh yeah, so I mentioned where do these things come from? They come from your balance sheets. Have we talked about balance sheets yet? No, we haven't. Are they rocket surgery? No, they're not, but I still want to wait until we actually get to the webinar on them before I introduce another, busy element to this deck of slides. So I'm going to forego showing the balance sheets for the time being. We'll deliver them next week. For the sake of this exercise, if you haven't created balance sheets before, you can just do this from memory. In all honesty, that's where I got these numbers, was from memory. Yeah, so if you're kind of a beginner on the financial statement side of things, don't worry too much. Just give a ballpark estimate of where your inventories were at the end of last year and where they are now at the end of this year.
Actually, Andy, there's a question that's kind of related to that.
Yeah.
Someone asks, for small farms, can expenses be estimated or must all receipts be saved and all figures be exact? I know we're talking about memory for the sake of this, but overall.
Yeah. Yeah. Well, so it's a nice thought. And I think you could probably still get useful information for decision making from really good estimates. Um, but the tax man probably wants you to have pretty exact stuff. I'm going to talk about how we can keep track of the very detailed numbers. The receipts thing, okay. A lot of people have this vision of themselves walking into the tax accountant's office with a shoebox or maybe a refrigerator box full of receipts that they've collected over the course of the year. And really, that doesn't do you any favors and it doesn't do the tax man any favors either. I think that receipts are a useful tool for as long as they need to exist to get from where you had that transaction to where you record that transaction. So you stick it in your shirt pocket, you drive home, you get on your accounting software or your spreadsheet, depending on how you do it, and you say, we had this expense and it was for this purpose. Many times, people nowadays have an electronic record of those transactions that comes directly from your bank. Okay, when I am getting prepared for tax season, I'll go through and I'll download all the transactions that I had for my farm over the course of that year, and then categorize those things according to Schedule F categories and make a document that my tax preparer can use to submit my Schedule F to the feds. All right. So, do I ever bring any receipts for him? No, I do not. Do I sometimes write down things that are random and didn't make a lot of sense so I can explain them to him? Yes, I do. If you're the type of person that keeps a lot of receipts around, that's fine. You can keep them for a number of years just as a backup records for what you're doing. But what I would encourage is to get those transactions recorded and booked in an electronic format as quickly as possible so that you're not trying to dig through your couch cushions and your sock drawer at the end of the year to make sure you had all your receipts included. Um, so the short answer to that question, yes, be exact. No, don't bring receipts to the tax man. Find an electronic way to keep track of this stuff. And if you're not the person that's going to be able to do that in an easy or comprehensive way, hire it done. It's not that hard to find a bookkeeper that will take care of some of this stuff for you. Any other clarifying questions, Larissa, about this stuff before I move forward?
Um, there was one from the last slide that's kind of similar.
Sure.
They're asking about property taxes and insurance. If you live on the farm, can those be accounted for? Kind of like the vehicle usage was.
Yes, absolutely. And we actually do that. Okay, I don't know if there is a specific rule that everyone should follow when you're doing that thing. But so I live on a 5-acre farmette. I pay property taxes on that farmette every year. Do I feel like it's reasonable and justified that the farm should be able to pay and therefore expense some portion of those property taxes each year? Yes, I do feel that way. Does my tax person agree with me? Yes, he actually does. So he has in his records a percentage of the property taxes that we attribute to the farm and the percentage of the property taxes that we attribute to the domicile, the home, the residence. Now, on a 5-acre parcel, obviously, the vast majority of the value of that parcel is going to be coming from the home, especially when the other acreage is just, pasture and not, prime productive crop ground or whatever. Um, so yes, I still do pay some of my taxes with farm dollars as a farm expense. I also pay some of my insurance with farm dollars as a farm expense. But that's broken up the same way, right? I've got one insurance policy through my insurance provider that covers not only the home and personal property, but also the farm and the farm personal property and even some of the farm commercial liability. Um, that takes a little bit more math on the part of either yourself combing through your unintelligible insurance documentation or somebody who's smart in the office and is willing to do a favor to keep your business and help you determine what portion of that premium you've paid over the course of the year is really attributable to the farm business. So that's what I would recommend. I'd work in close partnership with whoever it is that's the boost on the ground in your insurance provider's office and help come up with either a figure each year or a percentage each year that you're going to attribute as a farm expense and write off as a farm expense. Thanks for that question. Yeah, that's everybody who's running a small farm knows that it's kind of difficult to separate the farm from personal life, right? It's all kind of wadded together at the end of the year. And the best thing you can do is kind of create a consistent set of rules with your tax preparer that you use each year that are defensible in one way, shape, or form, either according to your logic and rationale or to the tax preparer's logic and rationale. Generally, they should know if it's logic and rationale that you come up with, whether or not it sounds like it's triggered an audit in other customers that they have had. Great questions. All right. Next piece we're going to get into here, the last bit of the accrual adjustments, and we're going to finish this income statement, right? Already! Yay! It's not that hard. Okay, here's your cash expenses. Here is the expense adjustments. So just like the income adjustments, what we're doing is we're looking at a couple of things on our balance sheet, especially the current assets and current liabilities part of our balance sheet, in changing these inventory balances. So last year, at the end of the year, I had about half a load of chicken feed in the bin. This year, I just got delivered a brand new load. It cost me about $1,300. All right. Supplies. In my case, this is egg cartons. In your case, it might be something different. So last year, at the end of the year, I had about $300 worth of egg cartons on hand, about a half a pallet. The end of the year, I got a brand new pallet's worth, 4,800 egg cartons or whatever it was, cost me $720. So there is my inventory adjustments for what I had on hand at the end of last year and what I had on hand at the end of this year. Okay, so a negative expense adjustment because I had more stuff on hand. Also, I had a bill that was due, or a couple of bills from my suppliers totaling up $1,050 that I had not yet paid at the end of the year. So a positive net adjustment to expenses due. Those things, come pretty close to canceling each other out, the 1170 negative and the 1050 positive. We add our depreciation, which came from the line 14 of the Schedule F, and we get ourselves into something that people in the biz like to call NFIFO, Net farm income from operations, $17,512. Okay, fine. And that is, slightly different than what we had in the 14s at the bottom of the Schedule F. What else do we need to adjust? All right, same procedures here. For interest, I pay my farm loans on a monthly basis. Not everybody does, and so my interest is always kept up to date, and therefore the accrued interest balance is always $0. However, I did also pay a total over the course of the year of $2,600 on farm loans in interest. Okay, so that gets us a net interest expense, a total farm expenses, and a net farm accrual income number of $14,912. So we did it, right? Here we are with a completed accrual adjusted income statement for Andy Larson's free range egg farm. Let's take a look at the results. After all of that hooting and hollering and messing about accrual adjustments, our accrual net farm income of $14,912 wasn't that different from the net farm profit of $14,530 on the bottom of our Schedule F. Okay, fine. This is only because our negative and positive expense adjustments were pretty similar in magnitude, and so they canceled each other out, but this isn't going to be the case every year. Plus, larger farms with larger inventories of crops or livestock or feed or supplies or whatever, or maybe they've just got a larger line of equipment and infrastructure that accumulate depreciation each year, they're likely to have a much more, let's call it remarkable difference between their bottom line net farm profit and their accrual adjusted net farm income. This also gives me the opportunity to calculate my operating profit margin. Okay, so I take my net farm income from operations minus the value of operator labor and divide by the value of farm production. So NFIFO right there, I minus the value of operator labor, which in my case, we don't pay ourselves, so it's kind of zero, and divide by the volume of farm production, which is just under a line N there of $57,438. So if I divide 17,512 divided by 57,438, I get 30.49%. Now, not too bad. Feels kind of healthy. But did I do something healthy by not subtracting any operator labor, by not paying myself? When I think about it, I kind of imagine what we would put in labor over the course of a year, and I think it's about 25 hours a week. And if we multiply that by $15 an hour, which if you don't think you have to pay your employees $15 an hour nowadays, you're kidding yourself. 25 hours times $15 times 52 weeks in a year equals 19,500. So if I take that 17,512 and I subtract 19,500 and I divide that negative number by 57,438, my profit margin doesn't look quite so good anymore. So are we paying for the privilege to raise hens and sell eggs? I mean, maybe a little bit, but we've got to think about what the other benefits we get out of this as a lifestyle as well. That is a perennial argument, whether or not farmers ought to pay themselves. Yeah, we oughta. Can we always know? Yeah, we'll have to have that over a six-pack sometime. But so the point, what is your banker going to do with this statement, right? First and foremost, they're going to look and see whether the net cash farm income is a positive number. If not, whether those fancy accrual adjustments that we talked about get you back to a positive number. Then they're going to make sure that your net farm income from operations plus your depreciation, right? Depreciation's not cash. You never wrote a check. So they add back that depreciation. Make sure that number is enough to make your farm loan payments. That's important to the banker. They'll probably calculate a debt service ratio. Last but not least, they'll look through the revenue and expense categories and make sure it sort of makes sense to them and things seem sort of congruent with what they understand about your farm. And if not, maybe take some notes as to why something seems really high or really low, and talk with you about it the next time you get together. So that's what's going to happen with that thing. Now, I picture a bunch of you looking at me like this. Even though I can't see anything, I can't hear anyone, I'm just imagining that this reaction is out there in the hinterlands right now. So nonplussed. All that work, and we got to this completed accrual adjusted farm income statement. So what? What do you mean, so what? They're more than just numbers on a sheet. They tell you what you really made on your farm this year. That's important. It's not just a gut feeling. It's not just something that's been monkeyed with by a million different people. How is that as well? So if I'm not counting my labor again, which is debatable, for every dollar I spend in my farm, I made $1.30. That sounds all right. I mean, okay, I can totally understand how 1 year's results might be underwhelming after all that work you went to creating them. But the real power in this comes in comparative analysis year to year, right? Did I increase my net farm income from last year to this year and in the projections for next year? Did I improve my margins? What were my main cost centers? How can I reduce them? Once you have, say, 5 years or so of income statements under your belt and you compare them side by side, you really start to see patterns and how your business is changing over the time, whether or not it's going in the right direction, and how to set goals, hopefully to grow it smarter. That's sort of a natural break. I've got more stuff here, Larissa, but did you have any other questions that came in that we want to address before we move from the basic income statement that we just completed?
There were a couple of questions about what software you had recommendations,
Mm.
and then also, the information about kind of CPA, like if it's someone that you really should have kind of a expertise in agriculture and farming, if those are things that you had thoughts about.
Yes and yes. We're going to get to software in just a minute here, in a couple of slides. As far as the people who are doing your farm accounting, yes, I would absolutely 100% encourage you to deal with an accountant, a bookkeeper, a CPA, whoever it happens to be, that has got some experience under their belt with farms. Farm statements look different. We're getting to that too. Farm schedules in your tax return look different. When I was banking, I saw some Schedule Fs that had all the farm expenses categorized under other. It was a disservice to that farmer, for a number of reasons. One, they didn't have any depreciation in there that I could add back. Two, so all the non-cash stuff was messed up. I mean, it's important to have service providers that speak the language when you're a farmer. We are an unconventional lot, us farmers, and we play by some specific rules. And if those folks that we're working with don't understand those rules, we're going to wind up succumbing to that garbage in, garbage out rule that says if we're not working with people who know how to speak the language, they're going to produce a result. But whether that result is actually reflective of the reality on your farm and with your farm's finances, that becomes a separate question entirely. But yeah, we'll get to the software here in just a minute here. Okay, so the other thing I really got to recommend, don't stop here. Yes, we just created a farm income statement. Big fat hairy deal, right? The Schedule F and this basic income statement are a nice foundation, but they're hardly comprehensive in terms of the information that you actually need to make informed farm financial decisions. So here's a simple example. The Schedule F doesn't have an expense line for advertising. Schedule C does. Non-farm businesses have that line. Schedule F does. Why? Well, It's probably an artifact of the idea that a typical commodity farm doesn't do any advertising in order to sell typical raw agricultural commodities, right? The corn farmer didn't have to take out an ad to sell it at the elevator. However, since you and me are in like the specialty slash niche slash value added market space, we may very well have expenses related to drumming up business, a slick website or ad placements on search engines and social media channels, maybe just free samples given away in a natural food store at a farmer's market. So consider bringing in and tracking some of those other relevant expense categories and adding them to the records that you keep. They can roll up into your Schedule F at tax time, either as an other on line 32 or roll them up into a different category. It doesn't matter either way as long as they get included. The other thing that neither of these documents delves into with any kind of specificity is how exactly your revenues roll in. So that one little line 2, asking about sales of livestock, produce, grains, and other products you raised, boy, that feels pretty lumped together. You got multiple product offerings sold through multiple market channels, and at the very least, you should be categorizing your revenues probably by livestock species, right? There's a lot of us who are livestock producers on this webinar. That's going to allow you to perform some basic enterprise analysis. Determine whether or not the critters that are out there, which ones are making you money and which ones aren't. Also, if you're still with me here, it probably means you're not too scared off by spreadsheets. Okay, if you want to become like a true farm profitability ninja, I've got a tool for you. I didn't do it, but I've got it for you. Livestock Compass is one of a series of Compass branded spreadsheet tools, along with Veggie Compass and O-Grain Compass, that are being made available for free, by the way, by the Center for Integrated Ag Systems at the University of Wisconsin. It's at that nice little URL down there, veggiecompass.com/livestockcompass. These things are awesome. And they make C3-56 look like a walk in the park. Although the color scheme is definitely more inviting. They'll walk you through feed and livestock production expenses by species and sales by individual market channel in order to get you to this nice last page analyzing which of those critters and which of those markets are actually proving profitable for your farm. Like, wow, you can do a lot with that information. You can upscale your beef production and reduce your lamb production, or vice versa, depending on which of those things you actually have a market demand for and which of those things don't have a major cost center associated with getting them to market. So really, really, really potent information for how you should change or improve the shape of your farm over time. Now this is how I picture you guys. Many of you out there are thinking something like, oh my gosh, these fancy spreadsheets are powerful and all fine, but I like something that's less manual. Something that's not so much record keeping and data entry. Isn't there an easier way? Like something a little more automatic or automated? Okay. First, let me once again honor the fact that the vast majority of you didn't get into farming because you really like bookwork. Most entrepreneurs don't. You got into farming because you love animals, or you wanted to get back to the land, or you wanted to get your hands dirty, or you wanted to be your own boss, whatever. I get it. But that being said, entrepreneurship, writ large, is management, not just labor. The buck literally stops with you. You have to sell products, you have to make payroll, you have to pay taxes, you have to cultivate customers, and you have to enter and exit market channels. Like all these things, you are the decider. If you don't have the information you need to be the decider, your success or failure as an entrepreneur, as a farm entrepreneur, comes down to luck and gut feelings. I don't like relying on luck and gut feelings. And if that's not good enough for you, you have to put in the work. And this is work. This is probably more highly paid work than the work we do on our farms, right? If you don't have the time or the capability to put in this kind of work, you're going to need to hire it done because you need this information to make good business decisions. There are tools that will make your book work more streamlined. Okay, I'm going to mention a couple. It's not necessarily an advertisement, it's just mentioning them, right? So, regardless of what you think about QuickBooks, it's been around forever and it's pretty much become the industry standard amongst, well, entrepreneurs of all stripes, which means it's easier to find accountants and other technical assistance providers who understand it and support it. No, it's not free. It will cost you money every month, especially as they move to this subscription model. But whether you consider it cheap or expensive depends on the value that you place on the capabilities it provides. Okay. If you're really strapped, there are other options. Okay. Wave accounting is another option, and it currently gives away much of its functionality. Not all, but much. There's a couple software platforms that were created specifically with farms in mind. I've only used one of them. It doesn't seem like there's a clear winner that has risen to the top the way that kind of QuickBooks has in the general entrepreneurship community. So honestly, it's hard to get away from recommending that people learn QuickBooks because it is a very universal language. If you're working with a farm accountant, there's a pretty good chance that that farm accountant uses a specific software suite that's farm specific. So as you're choosing your technical service providers, I would use that as informational in which software you choose for your operation. So all these products, they can connect with your bank account. Cool. They can categorize transactions automatically, even though not accurately. They can create invoices. You can generate your financial reports, including an income statement. Cool, right? But, if you yourself don't do the due diligence to make sure that what your accounting software is spitting out actually reflects reality, then, as a wise person once said, garbage in, garbage out, right? As a banker, I received a lot of software generated reports. They were full of numbers. Not all those numbers made a lot of sense to me. And when I asked the customer about those numbers that didn't make a lot of sense, the most common response was, I have no idea where that came from. I have no idea where QuickBooks got that. Okay, this makes the lender's job a little bit harder, fine, but you want to be a master of that domain. You want to understand your QuickBooks software or your other accounting software if that's what you're going to be using. But another but, right? If you're going to rely on software for your accounting and record keeping, do yourself a huge, massive accounting life changing favor. Make sure that you start by setting up your chart of accounts correctly right from the word go. So the chart of accounts is just your foundational rubric for how all financial occurrences, for lack of a better word, on your farm can be categorized in your software. If you want a clear income statement that's actually useful to you and your ag lender and your tax accountant, you have to set up income and expense categories that accurately describe what's taking place on your farm, of course, but then can be rolled up into Schedule F categories at tax time. If you want a clear balance sheet that accurately describes your farm business, what it owns and what equity is in there, you're going to need to add a bunch of categories for things like market livestock and breeding livestock and maybe a whole section for intermediate assets and liabilities. These things aren't necessarily in there right from the word go. Why? Why am I spending so much time harping on this? Because I've done it wrong before. And it seriously limited the functionality and the value I could get out of this software subscription. The vast majority of businesses are not farm businesses. They file one of these things at the end of the year. And so the defaults built into the chart of accounts in most popular accounting software platforms that aren't farm specific are the same as what you see or similar to what you see on the Schedule C at tax time and not on the Schedule F. All right. So if you're going to be a Schedule F business in Schedule C design software, you're going to have to make some modifications in order to make it accurately work for you. So do that right from the word one. And I believe that many of those softwares will provide either for free or not an individualized consultation with getting set up the right way. Take advantage of something like that because it's going to make your life a lot easier down the road. Okay, so Schedule C businesses and Schedule F businesses. Schedule C on the left, right? On the left, correct? And Schedule F on the right, the profit and loss from farming. All right, they don't look that different. Well, they're tiny on a PowerPoint slide, right? It's a familiar layout at least, with the income section on top and the expense section on the bottom. Great. Many of the categories are different though, and that can have big ramifications on how a company keeps its books. First and foremost, I've said the acronym COGS a couple times already. Line 4, Part 1, on the Schedule C, there's a thing called cost of goods sold. Non-farm businesses account for their expenses differently than farms do. The saleable goods of most Schedule C businesses don't do things like reproduce and gain weight and gain value as they mature over the course of a growing season, right? This is pretty specific to farm. Generally speaking, a Schedule C business buys inventory, materials and supplies, and they pay labor to take that material and convert it into their final saleable good to add that value. Therefore, the cost of that material inventory and the cost of the labor directly used to manufacture that inventory are referred to as cost of goods sold, or COGS. They are frequently referred to as, here's one of those italicized important words, right? Direct expenses. They're directly attributable to the production of the business's saleable goods. And they vary with the scale of the business's production. If a business is producing fewer widgets, they buy fewer raw materials to produce widgets. COGS is subtracted. Woo! That went faster than I intended it to. Sorry. COGS is subtracted on the top part of the Schedule C. There's the gross sales minus the COGS to get yourself to a gross profit number. Okay? Part 2 lists the business's other expenses on a Schedule C beyond cost of goods sold. They're referred to generally as fixed expenses or overhead expenses because they don't vary directly with the scale of production. So advertising, rent, insurance, employees who are occupied with selling, those might not vary when the production volume moves up or down. So they're overhead expenses. So as a result, a Schedule C business is going to have an income statement that looks slightly different. So they're going to have the revenue on the top line, right? Then they're going to have this section figuring out cost of goods sold, inventories. We talked about inventories, right? So they're using their inventory here in the COGS. What do they have at the beginning? What do they have at the end? What are the expenses that are associated with that inventory in between to get yourself to that cost of goods sold and therefore your gross profit or loss if it's negative. Then on the expense side, overhead expenses, different categories than the Schedule F, but along the same lines to get themselves to that net income or loss on the bottom line. So, by the way, balance sheets for non-farm businesses tend to look different too. More on that next week. In this way of thinking, farms basically report all of our expenses as overhead. However, more advanced farm managers will often start to tease apart their expenses to at least determine their direct cost of production for each individual commodity. Like basically getting a cost of production. Why do they do that? Well, they know that when they sell that thing, they're selling it at a price that has some profit margin built into it. That's a topic for another day. We're running real short on time here, so I'm going to do what I promised that I said I would do. I'm going to say what I said. The income statement, one of the big three, along with the balance sheet and cash flow. It's also called the profit and loss or the P&L. Summarizes revenues and expenses. plus a few of those fancy accrual adjustments, right? It's a portrayal of your profitability over a certain time period. Your Schedule F is not exactly an income statement, just so you know, and it's going to be different between farms and non-farm businesses. So that's what we talked about over the course of this webinar. And wow, um, that's a lot of nerdery in one 80-minute space, right? Talked a lot about finances, and I appreciate all of those of you who are still with us. I'm going to figure out how to stop sharing here. And actually, no, I'll leave the share up so we've got some of that information there. I'll turn on my camera. And Larissa, we got about 10 minutes that we can attack some questions that may have come in through the chat pod.
Yeah. So I'm going to bring up my side so you can actually look at anything that comes up, if that makes sense.
There we go.
Sure.
Sure.
I'll get my file up. Here we go. All right.
By
So
the
this is
way,
actually,
one of the things that's hard about this is I have no idea if anybody thought any of those stupid dad jokes I made throughout this 80-minute session were funny at all.
I know. That's when you can't see the working chat, you do miss out on the emoticons. So let me scroll back up. There was a question about a little bit a while ago about where the family farm labor gets entered, and I didn't get
Yeah.
to ask you that in the moment, but um, you had a thought about that.
So family farm labor in general doesn't get added into these statements because most of the time family farms are set up either as a sole proprietorship, a partnership, an LLC, or a schedule, or excuse me, or a an S corp. And most families are taking that income as a draw. So that's really it doesn't really a draw is a thing that affects your equity. It doesn't affect your revenues or your expenses. The exception to that is when folks set up their business so that the operator is actually also an employee of their business. Um, there's benefits to that in being able to expense their own salary, which is pretty cool. But there's also additional cost to that in that you're going to have workers' comp and payroll tax and all that kind of stuff paid on your own income, as opposed to just plain old income taxes that would flow through to your um, personal tax return.
Oh, follow-up question on what you just spoke of. Someone wants to know if
Yeah.
you could touch on what a draw is.
Okay. So in that chart of account slide, we said revenues, expenses, assets and liabilities, and then equity. So the equity section is investments and draws. Draws are when you pull money out of your business for family living expenses. So at the end of the month, oftentimes, we'll have to pull a couple $100 out of the farm and use that to make ends meet on a bill or something that was unexpected for family purposes. That's a draw, and that draw is a removal of the retained earnings and the equity in your farm. It doesn't show up as an expense on the income statement when it's formatted that way.
Thank you. There was a couple questions just about follow-up from this presentation. I will be sending out recording and slides, a link to the slides, which were available it's available in the chat bar as well, and it's on our website tomorrow morning, along with a bunch of links and that Andy mentioned, and then also to some of our other services that are coming up. I don't know, Andy, if you want to take a minute just to talk about some of the other opportunities that we have coming up for livestock and poultry farmers, including the boot camp and the subscription service.
You have that on your last slide, right?
I do. I didn't know if you wanted to mention anything else about it since you'll be involved. So I can turn right to that.
Yeah, go ahead and bring it up. So Farm Financial Boot Camp is it's a deep dive, right? It's everybody working together. It's about 10 farms at a time working together to really learn about becoming an absolute financial ninja on on their farm. We go through marketing, we go through financial statements, we go through loans and investments, we go through investable business models. It's a wonderful opportunity to um, hone your craft in farm business management. And I would encourage you, if you're the type of person that likes that stuff, to apply for it and join us for a couple of days and really going into some serious depth. The other thing upcoming next week, we're going to talk about, we're going to have a similar webinar to this, but instead of income statements, we'll be talking about balance sheets, that inventory of assets and liabilities, and why those matter to your overall farm financial health.
Excellent. That's great. Yeah, so there is, let me just ask one more question, one more follow-up about just the accounting software. Uh, Andy, you mentioned that there were several that were specific for farms. And I know that you aren't necessarily recommending any of them, but what are their names, just so folks know?
Okay, the one that I have encountered on a regular basis in my neck of the woods is called PC Mars. PC-MARS. It is a farm specific record keeping and bookkeeping software that my farm tax accountant uses with a lot of his larger customers in conventional agriculture. It is built with farmers in mind. Um, and there are a number of competitors out there on the market, but that's the only one that I've used in any real depth. Um, it moves when you make certain entries to it and everything. That's how farmy it is. So that's the one that I've dealt with, but it's not the only one out there, and I can't say it's like the winner, right? It's not the only one that's out there. It's not the one that has made itself the dominant player in the field. I The only one with real dominance across multiple industries is QuickBooks, for better or for worse.
Okay. Um, all right. Well, let me just finish up here. I know we have to sign off in just a minute or two. Just a reminder to folks that there will be a short survey that will pop up on your screen as soon as we close out of this webinar. So please take a minute to give us your input. We also ask for topics that you might be interested in having us present on uh, in the future. We have a third webinar that we are still kind of sorting out exactly what it will be about. So give us some feedback about what you might want to learn more about. Also, recording of the webinar and the slides will be available soon. These documents will be archived on our website, and I'll be sending an email to folks in the morning. A quick plug for other opportunities that we just mentioned. Andy will be back with us next week, same time, same place, to talk about the other side of the equation, I should say, the balance sheets. In addition, we'll be accepting applications for our farm financial training boot camp, and then also online subscription service through the end of October. So please consider applying if that's something that you're looking to learn more about. We also have scholarships to conferences, trainings, and other educational events. So keep that in mind as you're planning ahead in for the fall and the winter. And I'll be sure to send out links to all of those in my follow up email as well. So I am afraid that that's all the time we have right now. I appreciate
I think people
everyone's
are probably exhausted. They're not afraid
time
with
to
all
go
the
to
time we have.
dinner. Thank you, Andy. It's wonderful to have you, and we'll look forward to next week. I'd like to thank everyone out there in the audience as well for your attention, your time, your feedback. Appreciate it as well. And I know there was someone asking about how to find our Facebook link. I'll send that out in our social media tag. So enjoy the rest of your evening, your week, and we will be in touch soon. Thanks again. Bye, everyone.
Bye bye.